Equity Mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we help you learn to invest in roughly 45 minutes or less. We break down the world of investing from beginning to dividends so that you can hopefully make some returns. My name's Bryce, and as always, I'm joined by my equity buddy, Ren. How's it going, bro?
It's very good, Bryce. I am excited to be here once again with you.
Always excited.
Yeah.
Yeah.
Hopefully, listeners are noticing remarkably clear audio experience.
We hope.
Yeah, the episode we released last Thursday for us, last week when this comes out, we weren't particularly happy with.
No.
And I'm sure most listeners weren't particularly happy with it either. So we apologise for that.
Yes.
And we're working on repenting. And hopefully this episode is, goes part of the way to making it up to you all.
Yes, so if you've just joined the show, this is the standard of audio quality that you should come to expect from now.
Don't listen to last Thursday's app.
If you have just joined the show, welcome to our journey of investing. Welcome to the community of Equity Mates, where we are all about breaking down the barriers to the markets and making them as accessible as possible to everyone. So today, Ren, we've kind of missed or overshot tax time. In sense of the end of the tax year was end of June.
I think you have until mid-October to get your tax return in.
I think that's right.
Not everyone's a keen bean like you, Bryce.
I actually waited longer than any year I had.
5th of July this time.
So, Ren, today we haven't addressed tax this year. Usually we do a tax return episode each year.
Usually. We've been through 3.
Hey.
Yeah, that's not bad. 3, yeah.
Tradition's tradition.
Yeah.
So today we are going to do something slightly different. Rather than go through all things tax and investing, we're just going to discuss what we have done with our tax return.
Yeah, it's a question that we get occasionally, and it's not something that we can answer specifically for people when they contact us because we're not financial professionals. We don't give financial advice. So we thought, rather than just giving people the wholly unsatisfactory answer of, sorry, we can't help you, we thought maybe we would do an episode on what we have done personally with our tax return and then also speak to some of our equity mates and find out what they have done with theirs. Now, it goes without saying, but obviously we don't know your personal circumstances. This is all general and this is all what we do in our personal lives. Speak to a financial professional. So, yeah, look, we think it's a very rare circumstance that you get a lump sum in your account.
If you're lucky enough to do so.
Yeah.
Not everyone gets large lump sums.
Yes.
Or small lump sums. Some people end up owing money.
That is true. Well, then this episode probably isn't for you. This episode is probably just rubbing salt in the wounds. But maybe you can take the lessons and apply it to another time that you get a large lump sum in your account.
My housemate Ren is avoiding doing his tax returns because I think 2 years ago he found out that he owed the tax office about $3,000. So rather than face up to the fact and pay for it, he has avoided doing tax returns from here on in. So
I don't think you are allowed to do that. I know you seem to think that somehow he's allowed to, but
I don't know if he's allowed to.
I think you have to put a tax return in every year.
Yeah, I think you're right, Ren. I know that you, for a number of reasons, you don't have to lodge a return, but at some point it will all catch up with you and then they lodge it all at one point in time and you'll owe probably even more money.
Do not take tax advice from this podcast.
Anyway, Ren, let's
listen to my co-host.
Let's actually talk about our return and what we did with it, maybe from an investing standpoint. Even if we didn't do anything from an investing standpoint, it'd be interesting to understand what you did. So do you want to kick it off?
Yeah, so I have a credit card and it is the bane of my existence and I'm working to get rid of it as quickly as possible. So most of the tax return I put straight onto the debt. The main reason for that is interest rates on credit cards are just stupid. What, they're like 19% or something. And making 19% a year in the market is a really good year. Paying 19% a year on whatever credit card debt I owe is guaranteed. So for me, it made more sense to wipe that debt first. I put a little bit in my IG account. I haven't done anything with it yet. It's just sitting there in cash, and I plan to invest it at some point. But for me, focusing on, we hate fees, and we can control unnecessary costs. And so focusing on just clearing that credit card and snapping it in half and never using it again is top of my priority list.
Nice. I am similar. I had a small amount on the credit card that I got rid of.
Yeah? You're down to zero?
Down to zero. Yeah.
Mate, you're so good.
Down to zero, but haven't cut it up or snapped it up. To your point, having it sitting there and paying 20% interest on it or whatever, stupid. So I cleared that, had a little left over. We're off to Japan. So going to put some towards that. Bit of a holiday, treat yourself kind of moment.
Yeah, I like it.
And then the remainders are now sitting in my investing account as well. Haven't made any purchases.
You paid off your whole credit card, you're funding a trip to Japan, and you're investing. Jeez, someone does all right for themselves.
Not funding. No, I wouldn't say funding the trip to Japan. No. It's going towards the trip to Japan.
Yeah.
Yeah, so historically though, if I was to look back over the last couple of years, obviously any debts as well, I like to clear using the tax return. And then last year, it also went into actually just a cash account at that point in time, because you remember I was quite bearish on the whole situation. Since then, I'm sure it's been muddled up and moved into the investing equities at some point. But historically speaking, it's generally a debt clearance and then an investing approach.
And is there any reason why you go in that order?
Exactly for your reasons. Like, I also kind of think it's maybe a psychological thing. Like, for some reason, I mean, it may be the same in your situation as well. We probably have the cash available to clear an amount of the debt as it stands, but there's something about taking it out of your investing account to clear the debt for me that's sort of like this weird psychological.
Yeah.
You know what I mean?
Yeah.
It's as if I've said that's for investing, and then you take it out and you're like, shit.
Yeah.
And so then when it's almost like this free money kind of tax return comes in, you're just like, I take the opportunity just to sack it, get rid of it.
Yeah, that's the reason why I actually fund my whole existence on a credit card and put all my money into my investing account. Because I feel like I've got more invested.
Don't you listen to Ren for budgeting advice.
So there's definitely a mathematical reason, and it's just that the interest that you pay on high interest debt is really financially crippling. But then, there's definitely a psychological reason as well. I think Dave Ramsey he's like a big US radio host who does like a financial show, and he talks about just the psychological effect of paying back debts and just closing out some of those. If you've got like 6 or 7 different debts, credit card, car loan, mortgage, whatever it is, just clearing some of those off your books completely, and like the effect that has on how in control you feel of your whole financial situation.
Yeah, big time.
And so for me, clearing this credit card is just going to be a weight off my shoulders, and then we'll go to Japan and I'll probably start putting stuff back on again.
Mind you, I've never had more than one credit card, and I always have small limit on the card so that it can never be just like, some of our mates have like $30,000 limit and stuff, which, I mean, I don't know what everyone's situation is, but for me, that's just...
Yeah, that's too much.
Ridiculous.
Yeah.
Absolutely ridiculous.
Yeah.
But anyway, so that's what we've done this year. We have reached out to our Equity Mate community, to some of our expert investors, to get their opinion on, and I guess thoughts on what they do with their tax returns. And so I think what we'll do, Ren, is listen to a few of them now, maybe comment what we think, and then wrap it up.
Sounds good.
So who have we got first?
We've got Louise Bedford.
Yeah, so Louise joined us on the show a few months ago. She was otherwise known as the Queen of Candlesticks.
Yeah. Loved
day trading. She ran her own sort of masterclass online. And I think it'll be interesting to hear what she has to say.
Equity Mate.
Louise Bedford here, best-selling author of several books on the share market. So you've received a tax return. Just what should you do? If you're like the majority of people, they go, heck, free money, I'm just going to spend it. But for goodness sake, don't be like the majority of the people. To live an extraordinary life, you need to set yourself apart from that majority. So the first thing to do is, if you have any credit card debt, put that money towards your credit card debt. Keep 10% though. I'm about to tell you what to do with that 10%. If you have several loans or several credit cards, find the highest percent rate that you're being charged and put that money on that card, because that will give you the biggest kick over the long run. Now, let's say you don't have any personal loans and you don't have any credit card debt. I would be putting that money towards your own personal financial literacy education. But keep that 10% as I mentioned. You want to do something that's special for yourself and perhaps the people who've supported you along the way. Get something that could be either personally meaningful, an experience, or a gift to show someone in your life that you care for them. Now, what will this do for you? It will help keep you out of debt. It will help keep your future self happy because you're providing education. And it will give you an attitude of abundance, because by thinking of the people who help us along the way, we grow ourselves.
Nice. Well, Ren, from that, I guess I'm expecting some sort of gift to be coming my way.
I was about to make the same joke to you. We've been doing this podcast together too long.
So what are your thoughts?
Well, I think Louise is the kind of person that could sell ice to an Eskimo. I want to live an extraordinary life. She's very motivating. But no, I think her advice is, well, her thoughts are really good. I think, we touched on the whole paying down debt thing. So great minds think alike, I guess. Investing in your financial literacy, I think, is a good advice. You could probably generalize it a bit more and say, invest in personal growth, whatever it is. You probably don't need to invest in financial literacy because you're already listening to this podcast.
Exactly.
And we don't charge you for it. I think that's a really good way to think about it.
Yeah, I mean, from a framework point of view, strategy point of view, I feel like we followed pretty well what she was talking about there. Pay down the debt, choose the one that has the highest interest rate, treat yourself, and then buy each other a gift.
Yeah, well, what are you going to get me?
Mate, I might buy you some sushi in Japan.
Oh, there you go.
With my tax return. There you go. All right, so that's Louise. Who else have we got?
Next up, we've got Ted Richards.
Yep. So premiership player for the Sydney Swans. He's been on the show a couple of times.
Yeah.
Let's hear what he has to say.
Equity, mate.
Okay, what would I do with my tax return? Let's assume that you don't have any bad debt like credit cards, as bad debt like that really should be paid off first. And let's also acknowledge that there's probably something that you really want to buy right now. Could be a big ticket item like a new car or something like that, or something smaller like a new pair of headphones. Whatever it is, it doesn't matter. There's always going to be one more thing that you want, and you can probably think of one right now. This is called lifestyle creep. I played football professionally for 16 years. I was amazed with how so often my teammates' contracts, they jumped up and became really big. So too would their spending patterns, which would jump up at just the same level too. So even though they were making big money, often they were spending big money too. So remember, it's not what you earn, it's what you burn. So with this in mind, I'd avoid the temptation to spend on the now, and I'd set up an investment portfolio for the future. Now, you may feel the urge to invest and load up on something flashy like some cryptocurrency, some new hot tech IPO, or some small mining company. I'd steer clear of this. I'd keep it simple, focus on proven asset classes, getting diversified, and keeping fees low. So I'd use ETFs to get exposure to Aussie and international shares, property, infrastructure, and also defensive assets in there too, like bonds, which I know are boring, but they can provide resilience to your portfolio over time. Great thing is portfolios like this, which I've just mentioned over all these asset classes, can actually be set up for a fraction of the price that it once cost with online providers out there like Six Park and others. Now, full disclosure, I am biased. I work with Six Park, but the example I want to provide here is if you set up and create a portfolio with Six Park with, say, $10,000 in it, you'll only pay $50 a year for it to be looked after for you. That's 0.5%. And who knows what this might grow to in, say, 5 or 10 years' time. If you don't want to use an online provider, you can always do it yourself. But I think for $50, it's a pretty decent set and forget strategy to have it professionally managed for you. So that's what I do. Will you get rich by investing your tax return like this? No. But you'll be creating a nest egg for yourself in life that will grow. This could be the start of something that you'll add to over the years. Could be a life skill that you'll build on. Who knows what it'll grow to? But just like studying for an exam, often the hardest part is just starting, sitting down and getting it done. And that's how I'd invest my tax return.
Nice, Teddy.
Yeah. I want to hear some stories about footy players' lifestyle creep.
True.
Yeah, I've noticed your lifestyle's been creeping a little bit recently.
Unfortunately, my income hasn't though, Ren.
Yeah.
So I liked that. Different take. I mean, started out pretty similar to how Louise started and how we think about it, obviously paying down any of those bad debts that you may have.
Yeah, I think it's a common theme that we will hear over and over again.
And it's important to recognise, I guess, the difference between bad debt and, I guess, good debt.
What's good debt?
I guess debt that is perhaps structured in a way that you can manage it properly and with proper cash flow. So, for example, your mortgage, you have set payments at, I guess, much more affordable interest rates, whereas a credit card, you don't have a requirement to pay it back, and so it can build up and build up over time, and the interest rate is obviously a lot higher. And I also think that the way I would classify good debt as well is if it's actually going towards another asset, whereas bad debt, for example, credit card, personal loan, is more likely that you've bought a flight or, you know, something that's not really going to generate you any income or return later on down the track.
Yeah, and this may be wrong, but as I understand it, credit card interest will compound.
Yeah.
Yeah, so
time.
the 20% interest that you're charged will get added to the debt that you owe.
Yeah.
And so then your next interest payment will include the previous interest unless you paid it off in that time. So it'll compound and it'll snowball. Whereas with mortgages, there's probably no benefit in paying it off earlier.
I think for some mortgages, yeah, they almost discourage you paying off. It just sits in your offset account is what I understand. Anyway,
Mortgages
we're not here to talk about that. Yeah.
No, but it's an interesting one. Good debt v bad debt. There's probably some merit to it, but it's not something I've ever really thought about as a distinction.
No.
Yeah.
But what about Ted's, I guess, strategy of resisting the urge to splash the cash when you get it? What did he say? It's not about what you earn, it's about what you burn.
Yeah.
I really liked that.
Yeah, he said don't invest in crypto though. So I don't know what you and him are not on the same page then, I guess.
Small exposure to crypto, Ren. And look, I think there are instances where it is difficult to, I guess, not go out and buy that new bike or whatever it may be. But I certainly agree with his philosophy that if you can put it away now and get in that mindset of set and forget, a month after getting your tax return, you're really not going to notice the difference between that new bike or not, to be honest, in my opinion. And you're definitely going to notice the difference between having a nest egg growing now than starting to grow it in 10 years' time.
Yeah. I mean, you'll probably notice the new bike because, like, you'll see it every day. You might ride it a lot.
I keep my bike in my cupboard, so...
It's an investment.
Yeah.
Yeah, but... I mean, it really reinforces the message that we keep talking about, which is delayed gratification, the benefits of long-term investing. I didn't even mind the shameless plug, to be honest.
Yeah, look, it reinforced to me that there's a number of products out there that you can really access pretty cheap.
Yeah,
$50. I mean, gee, it's pretty cheap.
It is. You could spend some of your tax return on it.
True. All right, Ren. Well, lucky last two have we got?
We've got Mark Bernberg.
Oh, yeah. One of our, I guess, most popular episodes that we've done this year. He was the expert in cannabis. He runs the Green Fund.
Not that our other two guests weren't popular.
No, not at all.
Mark just has a structural advantage with the topic that he's talking about, I feel.
And a very entertaining guy to talk to. So very keen to hear what he has to say.
Yes.
I'm sure it involves cannabis.
Equity Mate.
What should you do with your tax return? Hi, I'm Mark Bernberg, founder and CEO of thegreenfund.com. And it's a great question, and it's one that I normally give quite a bit of thought to as we move into the new financial year. From my perspective, what I do is I always take a little piece of my return and put it back into my offset account for my primary residence. Nothing is more important than your home, and always protect your home more than anything else. So I like to just stabilize my offset account and just top that up a little bit. And then for me from there, I very much like to invest it into the equity markets. Some of you know, or some of you may not know, I'm very heavily invested in the cannabis industry and cannabis stocks in general. And so most of my tax return gets reinvested back into my two portfolios. My one is a sort of more short-term and medium-term portfolio, much more opportunistic in nature, a lot more speculative, but opportunity for really solid gains, taking advantage of the fluctuations and volatility that one experiences in the cannabis industry. And then my other portfolio is a lot more long-term. It's a much higher quality portfolio, looking for companies that are hopefully going to be the doyens of the industry, the backbone of the industry, and will dominate your large indexes. And so spreading out the risk, and that's very important. And I think more important for everybody to always understand is that you must diversify any investment you make. So just because I've told you about my cannabis funds doesn't necessarily mean that that's the only investment I have. I have investments in property, investments in other businesses, investments in other income generating stocks. So diversification is absolutely key. Plan what it is you're interested in and you want to do with it, with your cash, and then spread it out, have some fun, and good luck for the next return.
Nice one, Ren. Well, I think we started the show apologising for the audio quality, so we'll have to apologise on Mark's behalf there for any static that was coming through. But
unless we can take it out in editing, and then we don't apologise for anything.
True. So what are your thoughts on that, Ren? I like, from my point of view, the fact that obviously he's addressing his debt again from a mortgage point of view, something that you and I haven't experienced yet. But I also like that he has two portfolios that he splits between. One that is more short and medium term, probably a bit more riskier than his longer term portfolio. And I don't necessarily see the way that I invest, I don't really split in my mind. I don't have more than one portfolio as such. I don't know what you think about it, but I just split it in terms of, I guess, longer term investments and some that may pay off in the shorter term.
Traditionally, I haven't, but probably in the last 6 months, I've started thinking about splitting what I do into discretionary and non-discretionary. And the non-discretionary is your big ETFs, your standard companies that I'm not planning to sell for forever, I guess, really. And then discretionary may be some more shorter term investments where I'm trying to be a little bit more active. Part of the reason, this is completely off tax return, but given you asked the question, part of the reason for me is I want to measure how I go in the active part of my portfolio against the non-discretionary, the passive part. And if the passive part continually outperforms the active part, then that'll be a signal to me that I need to stop trying to make bets and just put it into longer term stuff. But if I do outperform, then great.
Or get better at making bets.
Well, yeah, that's the other alternative, yeah.
And they're not bets, right?
No, they're investments. Yeah.
Nice.
Yeah, well, no, but I thought what Mark said was good. It was obviously more investing focused, but I think we're an investing podcast, and if you pay down your debts and you're in a position to invest, I think what he was talking about around diversifying and all that is really important.
Yeah, I agree. Well, that was a neat little summary of what we've done with our tax return. And as you heard, what some of our Equity Mates community have also done with theirs. Hopefully it's inspired you to have a think about perhaps what you would do differently with your return. It's not often that you get come into a nice sum of money depending on your situation. So make the most of it when you get it, I guess, is our message. And considering that we're all about investing on this side of the mics, throwing it into something that is going to grow over a longer period of time and work for you is probably something that we both certainly consider, Ren. So always good to chat stocks and markets with you, and looking forward to next episode.
Sounds good.
Equity Mates and the people appearing in this program may have positions in the companies mentioned. This is general advice only. Please speak to a financial professional to understand how it may pertain to your individual situation.
Equity Mate.